Alfonso Cahero, A Journey into Finance History, Chapter 55. Bitcoin and the Emergence of Cryptocurrency, 2009. In the quiet, anonymous corridors of the internet, a groundbreaking idea began to take shape. It was the year 2008, and the world was reeling from a financial crisis that had shaken trust in traditional banking systems. Amidst this chaos, a white paper titled Bitcoin, a peer-to-peer electronic cash system, was quietly published under the pseudonym Satoshi Nakamoto. This document proposed a new kind of currency, one that didn't rely on banks or governments. Instead, it was based on cryptographic proof. Bitcoin would allow people to send money directly to each other without intermediaries. The idea was revolutionary, and it promised to change the world. As the paper circulated among cryptographers and computer enthusiasts, it generated a buzz of excitement. Who was Satoshi Nakamoto? Was this even possible? Skeptics abounded, but a small, dedicated group of believers started working on the first implementation of Bitcoin. The dawn of a new era was just beginning. January 3, 2009, marked a historic moment. The first Bitcoin block, known as the Genesis block, was mined. Embedded within the code was a cryptic message. The Times, 03 Jan 2009, Chancellor on brink of second bailout for banks. This message wasn't just a timestamp. It was a political statement, hinting at the motivations behind Bitcoin's creation. Satoshi Nakamoto's creation wasn't just software. It was a symbol of resistance against centralized financial power. As more blocks were mined and the blockchain grew, a small but passionate community began to form around Bitcoin. Early adopters were visionaries, technophiles, and libertarians who saw in Bitcoin a tool for freedom and innovation. Despite the growing interest, Bitcoin remained largely an experiment, a fascinating but niche project. Few could have predicted how this digital currency would eventually ignite a global financial revolution. The roots of Bitcoin can be traced back to the cypherpunk movement, a group of activists advocating for privacy-enhancing technologies as a means to achieve social and political change. These pioneers, who communicated through encrypted email lists, had long envisioned a world where individuals could transact freely, without oversight from governments or corporations. Bitcoin was the embodiment of the cypherpunk's dream. Figures like Hal Finney, a renowned cryptographer and programmer, were among the first to engage with Satoshi Nakamoto. Finney became one of the earliest miners and the recipient of the first Bitcoin transaction when Satoshi sent him 10 Bitcoins. These early exchanges were more than technical tests. They were proof that the dream was possible. As more cypherpunks joined the experiment, Bitcoin's blockchain grew steadily, block by block, transaction by transaction. As Bitcoin's network expanded, so did the challenges. Early adopters faced numerous technical issues, from software bugs to security vulnerabilities. The decentralized nature of Bitcoin meant that any flaw could potentially be catastrophic, but it also meant that the community had to come together to solve these problems. One significant challenge was scalability. Bitcoin's design limited the number of transactions per second, a constraint that would become a major issue as more people began to use the network. Solutions like the Lightning Network were proposed to address these problems, but implementation was still in its infancy. Despite these growing pains, the community remained optimistic. Forums and chat rooms buzzed with ideas and debates. The price of Bitcoin, initially valued at virtually nothing, began to see its first small surges as interest grew. The seeds of a financial revolution were being sown, though it would take time and perseverance to see them blossom. On May 22, 2010, a milestone was achieved that would later be celebrated annually as Bitcoin Pizza Day. Laszlo Hanyecz, a programmer and early Bitcoin enthusiast, made history by conducting the first real-world transaction using Bitcoin. He paid 10,000 Bitcoins for 2 pizzas from Papa John's, facilitated by another forum member who placed the order and delivered the pizzas. At the time, this seemed like a fun experiment, a way to demonstrate Bitcoin's potential as a medium of exchange. However, those 10,000 Bitcoins, worth roughly $41 at the time, would later be valued at millions of dollars, highlighting Bitcoin's volatility and the growing interest in this new form of money. This transaction sparked further interest and proved that Bitcoin could be used for everyday purchases. It was a tangible example of how digital currency could break free from the confines of the internet and enter the real world, paving the way for broader adoption. As Bitcoin gained traction, it caught the attention of not just enthusiasts and innovators, but also those looking to exploit its anonymity for less savory purposes. In 2011, an underground marketplace known as Silk Road emerged on the darknet. This platform, accessible only through the Tor network, allowed users to buy and sell illegal goods and services using Bitcoin as the primary currency. Silk Road brought Bitcoin into the spotlight, but for all the wrong reasons. It painted Bitcoin as the currency of criminals and drug dealers, a reputation that would be hard to shake off. However, it also demonstrated Bitcoin's utility as a decentralized, anonymous form of money. The FBI eventually shut down Silk Road in 2013, and its founder, Ross Ulbricht, was arrested. The closure of Silk Road marked a turning point, bringing both increased scrutiny and legitimacy to Bitcoin. While it highlighted the need for regulation, it also underscored Bitcoin's potential to operate outside traditional financial systems. As Bitcoin's popularity grew, so did the number of platforms allowing users to buy, sell, and trade it. One of the earliest and most prominent exchanges was Mt. Gox, based in Tokyo. At its peak, Mt. Gox handled over 70% of all Bitcoin transactions worldwide, making it a cornerstone of the Bitcoin economy. However, Mt. Gox was plagued by security issues and mismanagement. In February 2014, the exchange abruptly halted trading, closed its website, and filed for bankruptcy. It was revealed that approximately 850,000 Bitcoins had been stolen, a loss then valued at nearly $500 million. The collapse of Mt. Gox was a massive blow to the Bitcoin community, leading to a significant drop in Bitcoin's price and a wave of skepticism. It served as a harsh lesson on the importance of security and transparency in the burgeoning cryptocurrency market. Despite the setback, the resilience of the community became evident as new exchanges and businesses emerged, learning from the mistakes of the past. Bitcoin's success inspired a wave of innovation. Developers and entrepreneurs saw opportunities to build on its foundations, leading to the creation of alternative cryptocurrencies, or altcoins. Each of these new digital currencies aimed to address perceived shortcomings of Bitcoin or to introduce novel features. Among the first and most notable altcoins was Litecoin, created by former Google engineer Charlie Lee in 2011. Litecoin offered faster transaction times and a different hashing algorithm, distinguishing itself from Bitcoin. Other altcoins like Ripple and Ethereum brought further innovations. Ethereum, introduced by Vitalik Buterin in 2015, went beyond digital currency to offer a platform for decentralized applications, dApps, and smart contracts. This opened up new possibilities for blockchain technology, making it more than just a financial tool. The rise of altcoins diversified the cryptocurrency landscape, attracting more developers, investors, and users. While Bitcoin remained the dominant player, these new projects contributed to the broader ecosystem, fostering competition and innovation. As cryptocurrencies grew in popularity and value, governments and regulatory bodies began to take notice. Initially, many viewed Bitcoin with suspicion, associating it with criminal activities due to its use on platforms like Silk Road. However, as legitimate businesses started accepting Bitcoin and mainstream interest grew, the tone began to shift. Countries like Japan and Switzerland embraced Bitcoin, developing regulatory frameworks that allowed businesses to operate legally and securely. In the United States, the approach was more fragmented, with different states adopting varying stances. New York, for example, introduced the BIT license in 2015, setting stringent requirements for cryptocurrency businesses. Regulation brought legitimacy, but also challenges. Compliance costs and legal uncertainties posed hurdles for startups and investors. Despite this, the regulatory clarity helped pave the way for broader adoption. Financial institutions started exploring blockchain technology, and major companies like Microsoft and Overstock began accepting Bitcoin payments. In 2017, the cryptocurrency world experienced a phenomenon that would both drive innovation and invite controversy: the initial coin offering ICO boom. ICOs allowed startups to raise capital by issuing new cryptocurrencies or tokens to investors, bypassing traditional venture capital routes. Ethereum's smart contract capabilities made ICOs easy to launch, and the potential for high returns attracted a flood of investors. Projects raised billions of dollars, fueling a frenzy of speculation. However, the lack of regulation and oversight led to numerous scams and failed projects, causing significant losses for many investors. The ICO boom highlighted both the potential and the pitfalls of the cryptocurrency space. It demonstrated the ability of blockchain technology to disrupt traditional finance, but also underscored the need for caution and regulation to protect investors.